Zoltan Pozsar says that the Fed will cause a depression. I'm your host, Steve Van Metre, and thanks for joining me today. And Credit Suisse economist, who many consider to be one of the foremost experts on the monetary system, is warning investors that the Fed is attempting to combat inflation by bringing asset prices down. And if they continue at their current pace, they're going to cause a depression. Let's over to Credit Suisse, where we kick today's story off with Zoltan's piece on war and interest rates. He says after visiting over 150 clients at 8 European capitals over the last 6 weeks, his impression is that the expected path of Western policy rates rests on two hopes. First, that inflation is about to peak, and second, that we are near peak in hawkishness. Well, the first one we can say for sure, because when we look at the consumer price index in blue on a year-over-year rate of change and compare it to the West Texas Intermediate crude, also on a year-over-year rate of change, that in red, and you can see that energy prices lead inflation. So the notion that we are somewhat, if not already at a peak, well, that is probably true. He goes on to say that obviously if the first view is right, that the second view is right too. It follows that the first view is wrong, inflation is driven by the economic war, not stimulus, that the second view is wrong too, and that we are not yet at peak hawkishness. The aim of today's dispatch is to highlight risk to the peak hawkishness view. We won't be forecasting, we'll be observing, and you'll draw your own conclusions, well, as Zoltan did too. And what he's trying to point out here is the Fed done talking up and raising rates? Are they at the peak? Well, we'll make that determination too. Let's continue on, because our jobs used to be simple, he says. Central banks became the epitome of transparency and with slight exaggeration. The only skill we needed to get by in markets was the ability to read and comprehend English, because central bankers have been saying for over a decade that their aim was to fight deflation by inflating asset prices, and all we had to do was borrow at low rates and buy assets irrespective of quality. Now our jobs are becoming more difficult. And part of the reason this is because our monetary system is inherently deflationary. Now I know some are saying, well, wait a minute, inflation has still gone up over the years, right? But we've seen disinflation up until recently over the prior 40 years. And that's just the effects of an overall deflationary monetary system coming down from those peaks in the 70s and 80s. Let's continue on, because central bank policy objectives are also changing as they went from waging a war against deflationary impulses coming from the globalization of cheap resources, including labor, goods, and commodities, to clean up the inflationary impulses coming from a complex economic war. But now that the pillars of the low inflation world are changing, as central banks are done with fighting deflation with asset price inflation and are now fighting inflation with asset price deflation. Central banks are adapting to a world that's gone from having too much stuff and not enough demand to a world that has not enough stuff and too much demand. Today's inflation is more about supply and less about demand, and is more about geopolitics than domestic politics. And here we can see that exactly this is true. And we've made this case in the show before that the Fed wants to bring the stock market down. Now, many people say, well, no, the Fed, they're going to come in and rescue the markets if it goes down too much. The answer is no, because the U.S. economy has become such a function of the stock market that all the Fed has to do is bring stock prices down. That should bring demand down and bring consumer prices down. And because such a small percentage of the population actually participate in the market, if you can imagine that the wealthiest 10% of Americans own 90% of all stocks, that if they can bring stock prices down, it actually shouldn't have much of an effect on the broad economy. But it actually does, because you bring the stock market down, well, the economy slows down with it. But we can see from, at least from an inflation standpoint, we can see the Wilshire 5000 now in red overlaid against the consumer price index in blue, both on a year-over-year rate of change. And we didn't used to see this relationship, but now we can see the case where the stock market comes down and it leads the consumer price index lower. We see a stock market here coming down, and lo and behold, inflation following, stock market rising, kind of leading inflation with it, and now stock market heading down, inflation expected to go too. But perhaps the most unsettling parallel to the 1970s and early 1980s is the Fed and the market's assumption that all will take to break inflation is hiking interest rates, with the resolve and determination of Chair Paul Volcker, which is important to understand because Fed Chair Powell has been mentioning his name, and this is key to understand because Volcker, he actually triggered some recessions to bring inflation down, and perhaps even Fed Chair Powell is willing to do the same. And Paul Volcker is no doubt responsible for the deep recession of the early 1980s, but we shouldn't assume that the rate hikes in a recession are all that are needed to weed inflation from the system. Recessions can help, but may not be enough if you can only imagine, especially if Ray Dalio and Larry Fink are right and we're headed for stagflation, i.e. an environment where inflation remains persistent, whether there's growth or not. And if you think the peak tightening is 3.5% because inflation peaked, maybe it hasn't, and the cuts are coming next year because a recession is nigh and stocks are now at the cusp of a bear market, he says maybe not because we need a recession and lower asset prices or the path to a recession, you might be terribly wrong. And here we can see that we know the Fed is tightening into a recession, and the bond market is telling us this very clearly. It's also telling us, as our chief strategist Jeff Snyder tells us, that the probabilities that the Fed is going to reverse policy by the end of the year or into early next year are rising. Not because he says so or anyone else, it's because the bond market says this. And I want you to see just how key the bond market is here. We're going to look at the yield curve in blue, which is a 10-year Treasury yield minus a 2-year, and then we're going to overlay the federal funds rate in red. And we'll note that going into inversions, and we're inverted now, that the Fed is still hiking. And this doesn't make a lot of sense to people, that why would they do this? Here you can see an inversion in the late 80s, the Fed's still hiking. You see an inversion here in kind of the mid to late 90s. The Fed was kind of holding steady until they continued hiking into an inversion. Here another inversion, more rate hikes. And then we were seeing almost an inversion here in 2018 as the Fed was hiking. And now we're seeing one again. But how do you know, and this is a real key, how do you know that the Fed is going to reverse course and the bond market is telling them? Well, why not this? I'm going to invert the red line, the federal funds rate, and you're going to see, check this out, when you invert it, what it's telling us here is that the market is actually does not believe the Fed. So what's happening here is the Fed's raising the front end of the curve, the back end of it's coming down. That's the inversion. And if you look at this chart, again, flipping that red line, the federal funds rate over, you can see that what's happening here is the yield curve is telling the Fed you're making a big mistake by hiking, again, showing it going down, and that you're going to be reversing course sooner than you think. And is Jay Powell a dark horse who is more political than serious about inflation? Well, Zoltan says, I don't think so. Once you go down the path of invoking Paul Volcker's legacy, you can't avoid making good on that promise. If you do, you damage the Fed's reputation irreparably. The risks are such that Powell will try his very best to curb inflation, even at the cost of a depression and not getting reappointed. Now, if you're concerned at all that the Fed is going to drive the country into a recession, or even a depression, and what that could mean to your portfolio, well, there's one strategy called Portfolio Shield. I'll put a link here in the corner and the description below that hedges with bonds. And during depressions and recessions, rates crash, and that's what Portfolio Shield was designed to handle. Because here you can see that what the Fed has control over is the money supply. Now we'll show that in blue on a year-over-year rate change overlaid with the U.S. stock market, the Wilshire 5000 in red. And you'll note that there wasn't much of a relationship between these two, but they become more important lately. That is, the money supply is now leading kind of where the stock market is going. And we could see that, of course, stocks coming crashing down during the great financial crisis. The money supply then falls. You see it fell afterwards, but the Fed revives it. The market jumps on that. Now we see, of course, the money supply heading lower, the market following, slowing. Now the money supply rising. Of course, the money supply coming down, telling us that perhaps the Fed is indeed trying to do exactly what I said they're trying to do, and that's bring asset prices down. Because are we at peak hawkishness? Well, it doesn't look like it. As Fed nowhere near finished with inflation fight, according to Daly, Metre, price stability is our top goal. Daly says to ways off, and Evans hopeful on smaller rate hikes, but Bullard says there's no recession. And speaking at an event in New York, St. Louis Fed President James Bullard reiterated that the central bank probably should increase its benchmark range to a whopping 3.75% to 4% by year end. Evans says he is hopeful that a path to 3.5% funds rate by the end of the year via a half-point increase in September meeting, a quarter-point increase at meetings in November and December, well, still reasonable. And yet he goes on, and we see with this headline, the Bullard said the Fed could slow inflation without sparking recession. And boy, I tell you what, I don't agree with that at all. And since the modern central banks have more credibility than their counterparts in the 70s, he says, it appears that both the Fed and the ECB may be able to disinflate in an orderly manner and achieve a relatively soft landing. I'll tell you what, Bullard, I don't know about the Fed's credibility, but they don't have much in this part of the corner where I'm at. Not at all. Let's take a look at what's going on in the economy, because we got the services PMI today, came in at 56.7, shows that the services sector is still expanding at a faster rate, but that's going to change, and I can tell you why, because the employment index is at 49, which is a very slight contraction, but effectively unchanged from the month before. We see new orders are growing, supplier deliveries are slowing. But notably, prices are increasing at a slower rate. Backlogs are growing at a slower rate. There is your inflation component slowing down in backlogs. Supplier deliveries are slowing at a slower rate. Employment, of course, as I mentioned, contracting at a slower rate. But look at this. Inventory sentiment went from too low, is now the direction of heading too high, if you can believe that. So the services sector, which we were told was going to be booming, looks like it's starting to run out of steam. And with that, we head over to our chief strategist, Jeff Snyder, who talks about construction spending from yesterday, as total construction spending was thought to have declined 1.1% in June of 2022 from May, primarily due to a severe 1.6% month-over-month decline in construction spending for private residential structures. Private non-residential spending was also lower in June, falling 0.5% month-over-month. And he comments that sharply lower residential construction adds to the growing picture of a housing slump. And in 2022, non-residential investment has been falling since February, basically the same as the labor data and other macro statistics, suggesting not technical recession, but the beginning stages of a potentially far more serious contraction, something we see in the yield curve. Now, if you'd like to get Jeff's research, mine, and Tracy's shoe charts, our energy experts got her latest note coming tomorrow. There's a link for Markets Insider Pro in the description. Check that out. It's free for a limited time. All you have to do is put your email and look for a report tomorrow morning. I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.